CMG Oral Space Daily Insights, let's look at the differences between these terms, Hawkish and Dovish monetary policy. But before that, let's quickly have a look at these terms, interest rates and inflation. Inflation is a general increase in prices and fall in the purchasing power of money. An interest rate tells you how high the cost of borrowing is or high the rewards are for saving. So, if you are a borrower, the interest rate is the amount you are charged for borrowing money. The higher the percentage, the more you have to pay back for a loan of a given size. If you are a saver, the savings rate tells you how much money will be paid into your account as a percentage of your savings. The higher the savings rate, the more will be paid into your account for a given sized deposit. Now, back to the difference, Hawkish and Dovish monetary policy. In the context of monetary policy and central banking, the terms Hawkish and Dovish are used to describe the stance or approach of policymakers regarding interest rates and inflation control. A hawkish stance is one that prioritizes controlling inflation, even if it means higher interest rates and potentially slower economic growth. Characteristics: policymakers who are hawkish are concerned about inflationary pressures and are more likely to raise interest rates to keep inflation in check. They believe that low inflation is essential for long-term economic stability. Implications: higher interest rates can lead to slower economic growth and reduce borrowing and spending by consumers and businesses. However, it can also help prevent the economy from overheating and keeping inflation under control. A dovish stance, on the other hand, prioritizes economic growth and employment, even if it means tolerating higher inflation. Characteristics: policymakers who are dovish are more inclined to keep interest rates low to stimulate economic activity and reduce unemployment. They are less concerned about inflation and believe that higher growth and employment levels are more critical for the economy. Implications: lower interest rates can lead to increased borrowing and spending, which can stimulate economic growth. However, it can also lead to higher inflation if the economy grows too quickly. So, in summary, hawkish policy equals raising interest rates to combat inflation. Dovish monetary policy equals lowering interest rates to stimulate the economy. CMG oral space: poverty is a common enemy. Explore this page for more goodies.